So today, in this ridiculous market that keeps going up for no reason, I sold a put spread on the SPY expiring June 17 at a 277 strike, collecting 79 cents or $79. So pretty close to the current market price, which was around 292, 293. So while the SPY was trading at 293, I sold a short put at 277 and bought the 272 put for protection and also to minimize the buying power or the capital required for this trade, which is basically $500 minus the $79 that I collected. So about $421 is the capital required for this trade. And I keep the $79 as long as by June 17, the SPY is trading above 277. If the SPY is trading at 272 on expiration, then I'm going to pay $5 to close the trade or $500 to close the trade. I collected $79, so basically I'm losing $421. But anywhere below 272, I lose the same thing, which is $421. So that's my max loss. Anywhere above 277, I make $79. If SPY closes at 275, for example, so right over here, at expiration of June 17, then I'll have to pay about $2 or $200 to close the trade. So I would lose about $121 in that case. So it really depends where the SPY closes on June 17. But usually I don't go until expiration. I'll close it before expiration because as time goes by or as the SPY goes up, this $79 that I collected goes down in value and I can buy back the trade. I can close the trade for less than what I collected initially. So because the SPY was going up today, remember May 15, I opened a trade on the SPY at a June 15 expiration at a 260 strike, collected $75. Today I was able to close it for $38, so almost 50% in one day. But that's because the SPY is going up like crazy. Now I currently have about 5 positions on the SPY right now, and 2 of them actually were almost closed for profit. So this one here, June 12, with a 265 strike, could have closed it today for almost 50%. I think it was like $1 away, but I wasn't paying attention. So this one's showing almost 50% profit. This one's getting close, the June 10 270 strike. So I've got the 270 strike, 265 strike. I've got the one that I opened today at 277 strike. Now I've got this May 29. So remember May 29, I started off with a put spread at 275. So this one has 11 days to go, and this one is definitely showing more than 50% profit. But because the SPY dropped to 272 last week, I tried to mitigate this trade by selling a call spread against it at 295. But who would have known the SPY would go from 272 to 295 in 3 days? So I don't think I did anything wrong by selling a call spread. I had to start mitigating the trade. But in this ridiculous market, my call spread is now completely tested. And I'm losing money on the call spread. As you can see, almost $200. While my put spread, if I only kept the put spread that I started off initially, I would have been able to close this trade completely for my 50% profit. So if I create order here and remove the calls, I could see that I could have closed it for less than $35. And in this trade, I collected more than $70. So it's even more than 50% profit. But I'm unable to close it because I've sold that call spread. But what I could do is if the SPY continues to go up, I'm going to bring this put spread higher. So instead of bringing the call spread lower when the SPY is dropping, I'm going to bring the put spread higher if the SPY is going up and going past my 295 strike. And I've got the June 8th here expiration at a 274 strike. This one, I'm not sure if it's ready to be closed. Let's see. If I remove the call, you can see that it's close. It's not ready to be closed yet. But I also have a call spread at 300 strike. And it has 21 days to go. So who knows what's going to happen with this one. This SPY should drop. I mean, this is ridiculous. The market's going up like crazy. It's not normal. But it sure does make my put spread strategy on the SPY look good. I mean, since April, they're all complete winners because of this crazy rally. Now, these two are just causing me trouble because of the call spread that I had to sell against them. And I don't regret selling those call spreads because I think it was the right action to take. It's just that the market is being ridiculous, so it's not really my fault. And now my covered call on the Qs in my TFSA, the one I have at a 212 strike expiring May 22nd, well, now the Qs is flying away from me 227, and hopefully I'll be able to roll it forward for a credit and move a strike higher. But even if I move a strike higher, I'll be at 213, while you could see the Qs is at 227 and my purchase price is 221. So it's kind of annoying that the market is going up like that. And as you see right now, the only credit I can get is if I roll it to 212.5 strikes, so only 50 cents higher for the following week. If I go for 213, it doesn't give me a credit, it gives me a debit. I'm gonna have to pay. If I go for the same strike, I'll get a credit, but I'm not getting closer to the current market price, so that doesn't help. Unless I go to 213 strike, but then I go 2 weeks away, not just 1 week away. If I go to June 5th, I can collect the credit at a 213 strike. And let's see if I can get a credit at a 214 strike. No, I can't. Yeah. So I could play around with the expiration and the strikes, but as long as I do it for a credit. Now, last week on Friday, I sold a covered call on IWM at a 134 call when IWM was trading at around 124. And today IWM is getting close to 134, so now this 134 strike is looking dangerous, although last week it looked super fine. But regardless, we'll see. Hopefully by Friday IWM stays below 134, but if it's around 134, I should still be able to roll it forward for a credit and even go a strike higher. But you could see that I sold it for 36 cents and now it's worth $2.43. So whoever bought this option for 36 cents can actually make a good return in one day. I sold it on Friday and on Monday it's worth $2.43. Now I know I shouldn't be disappointed when the market goes up. It should be a good thing that the market is going up, but because I've got trades that are a little bit bearish, then it goes against my trades when the market goes up this way. I've got long positions on ETF, so I want the market to go up, but I'm also selling out of the money covered calls weekly, and the stock is just surpassing these out of the money strikes. So that's the problem, really. But the strategy in my margin account, which is put spreads on the SPY, that one is a completely bullish strategy, so that's good. And it's also a good protection against against the bearish market. If the market drops, I'm still able to make money off this type of trade and even collect a little bit more premiums if the volatility is higher. All right, so just wanted to share with you this trade I made today. If you have any questions, leave them in the comments section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back depending on your deposit, and you just need to make one trade. And the other one gives you $50 in free trades as long as you make a $1,000 deposit. Thanks for watching.